you're going to have quarters that you're just going to absolutely destroy what the market expectation was. And I think you're going to see the gold stocks start to move and ultimately lead down into a buying frenzy in the smaller spaces. It's going to be 7,000, maybe it's going to be $8,000 gold, and I think that there's going to be a lot of demand.
With gold, silver, and Bitcoin having fallen from its highs, silver down at least 40% at some point from peak to trough, and gold down 20%. Both metals have recovered from their lows just days ago, but is this the bottom? We'll find out with the next guest, Mike Allen, CEO of StrikePoint Gold. Welcome to the show, Mike. Good to see you.
Good to see you, David.
Investors are wondering, A, what happened? Is this flush out basically the end of this correction? I know that's separate questions here, but a lot has happened in just a very short period of time. From the beginning of the year, which was not only 6 weeks ago, we've had gold run up to $5,500, silver surpass $100, and in a matter of just hours, it seems, both metals have pulled back dramatically. Who's doing the selling? Who's doing the buying? Let's start there.
Who's doing the selling? Who's doing the buying? I think that if it was a stock and it ran up to the extent that you saw the people that it's just profit taking, but it's profit taking on a large scale. Whether it's central banks. I don't think that individuals on the street move the stock around, but there are obviously big players in the metal space. I also do wonder a certain amount of how it coincided with month end and production numbers production for the month being sent into the market, and then you just had a flood of materials enter into the market, and ultimately less demand or flooding the market and just overpowering the system in an instant. In my opinion, you're seeing gold and silver starting to rally again. I think that it briefly broke gold, which I monitor a bit more closely, broke through $5,000 today. It settled back down, but it's one of those whipsaw moments. And I feel we're reminiscent of where we were in October when gold moved through $4,200 for the first time, set a new record high. There was euphoria. People were dancing in the streets. And then a few days later, it punched back through on the way down. My gut, and it's nothing more than that, says that we'll sit here and settle around $4,900, $5,000, move sideways for a month or two, and then we're going to experience our next leg up, which is essentially what happened when gold moved up and down through $4,200. Crab sideways for a month and then legged up to where we are right now.
Mike, you're a geologist by background and training. Tell us about just the geology of gold overall in the context of the market action. Some have said for years that gold has been peaking. Peak gold has arrived not just this year, but many years ago. Can you just comment on peak gold and whether or not A, that's true, and B, if it is, how that's impacting market prices going forward?
Peak gold is a funny term. I mean, it's because you're implying an economics to it as well. I mean, projects that were uneconomic, 10 years, 15 years ago, are at different gold prices are wildly economic. I was just doing a back of the cocktail napkin, and we moved up $1,000 in the last year or whatever that number happens to be. But for 100,000 ounce a year producer, that $1,000 an ounce is $100 million onto the bottom line. And so it changes the economics. And so peak gold, for 1950s, both in terms of technology and in terms of costs, is different than peak gold in 2026 when you're sitting at $4,900, $5,000 an ounce. And those deposits that were not even being considered are being considered. I don't think that we're in a situation where we're going to run out of gold, but I think that the rush is going to be providing material to the market, whether it's whatever metals it happens to be. And being StrikePoint is in a jurisdiction like Nevada that has got a good mining history, that's where we tend to focus our efforts on. And it's a jurisdiction that you can actually permit projects, not just discover, but actually permit projects.
We're going to get to your project in Nevada in just a bit. It is in a tier 1 jurisdiction. But just on peak gold, is it true though that perhaps tier 1 gold deposits, high grade gold deposits, are getting scarcer, and it's actually more difficult and costlier to extract high grade ore out of the ground than, let's say, 20 years ago?
100% costs have gone up. And I would dare say that tier one assets. Well, I mean, yes and no. There is a chart that's out there of discoveries in the by the last decade, and the super giants, the 10 million ounces, are getting rarer. And I mean, the planet's not getting any bigger. However, the technology, and going back to the economics of it, the technology to look for things, and the technology and the economics to extract is much different at a higher gold price. The other part of it is the ability for some of these larger projects. The juniors can't really look for them, or can't explore for them effectively. In Nevada, there's a new discovery. It's probably the biggest discovery made in Nevada since the early 70s, and it's now called the Arthur Project. And it's the combination of the Silicon deposit and the Merlin deposit, and it's within Anglo Gold. Collectively, between those two deposits, it's a 16.6 million ounce discovery. Absolutely monstrous by any stretch of the imagination. This is in Nevada. This is in the Walker Lane. It's down the road a little bit from our project. And I actually owned a project that is now part of the Arthur project. But it's a 16 million ounce discovery. I think the first hole went into it in 2019, and it's an area that's been picked over. It's Nevada. Everybody has walked over that ground, and Anglo Gold got their courage up and drilled a monstrously deep hole, and they fudded on it, and they drilled another one, and they got it, and it's a massive new discovery. So these deposits can be found, big deposits can be found, but you've got to have courage to look deep, and you've got to have courage to go into places that are off the beaten track. And so if you're in a mature jurisdiction like Nevada, you might have to go out, drill a monstrously deep hole, or you might have to go onto the off the beaten track to find those big deposits. But I think that there are probably a few still out there to be found. And we'll have to see. The other thing that brings out the changes is these left lateral leaps in technology. The discoveries in Nevada in the 60s and 70s, the Carlin trends, those big disseminated bulk tonnage deposits, they were known about, but they weren't economic for a couple of reasons. The processing technology wasn't there to move or to process heap leach type ore. We were in a sort of a milling technology. Heap leaching was very revolutionary at the time. And then the other, just basic things that we take for granted day to day, the big equipment that we use in those big open pit heap leach projects didn't exist. Hydraulics didn't exist until the 1960s. Tire technology, just basic stuff, that all changes. And then you can get bigger and bigger equipment, and the economics change, and bang, you've got a monstrous mine.
Why hasn't the gold mining industry experienced what the oil industry experienced with fracking, for example, which is not just an incremental step or evolution? It's a structural shift in the way the mineral or resource is extracted. It was a jump step. Has the industry in gold experienced anything like that in the last 50 years?
I would argue that the heat in the last 50 years, okay, it's 60 now, but the 1960s, the heap leaching technology, 100% was a lockstep change. Since then, I would agree with your point that there hasn't been much. I mean, we've got autonomous trucks to a certain extent, semi-autogenous grinding. Okay, put less balls into the mill. There hasn't been those big, to your point, big steps like what the oil industry has happened. And a part of it is actually, if you compare the size of the oil industry to the size of the mining industry or the gold industry, it's a completely different game. I mean, oil is a much more valuable commodity. Payback on wells is measured in days, where so the mining projects it's measured in years. And even just the permitting regimes, they're completely different industries. So it's not really, the technology is improving and getting better, but I think that the business of oil is much bigger than the business of mining.
Is it a technological hurdle that the gold industry has to overcome, or perhaps the gold industry just wants to keep supply limited to keep the value high. What do you think?
Oh, I don't know if I would go that far. I mean, the mining industry has its cyclicity to it, and definitely that is it does impede itself. The best solution to high prices is high prices, and more mines get put online, and then supply overwhelms demand, and prices crater. And the best solution for low prices is low prices. Mines get turned off, exploration gets shut off, and you've got no more new discoveries. So there is a yin and a yang to that.
I want you to imagine your first day on the job as a geologist, way back in the day for you. And if I were to tell you transporting it back, well, I'm not trying to say that you're old. I'm just saying you're a very experienced veteran in the industry. That's what I meant to say.
All right.
But imagine your first day in the job, and somebody told you, look, Mike, one day gold's going to be $5,000 an ounce. How would you envision your job as a geologist to be different in that $5,000 an ounce environment compared to, let's say, when you first started?
Well, when I started, I actually can remember the day that I had paper copy of my application to apply to graduate from universities. This is back in the day. This is the late '90s, and I looked over at the newspaper box. I used to, and gold hits 20-year lows. That was the front page of the Edmonton Journal. It's like, oh boy, this is going to be tough, and gold being $5,000. I mean, this is all about timing and knowing when the moves are going to happen. That's what creates the opportunity. It's interesting because I think that if I would have known that, someday in my lifetime, gold would go from $250 an ounce to $5,000 an ounce. I'd become a land baron. You look at some of the models of different companies that are buying out of the money ounces and just hoping that they skate on side at a higher gold price, and that model is effective. I think that I probably would have gone that route if I would have known. Okay, sometime in my lifetime, gold's going to be at $5,000 from 200 or 250. Absolutely, that would have been the play to make.
Well, how does it change a geologist's job? Let's say $200 gold versus $5,000 gold, fundamentally.
Fundamentally, I mean, again, I would go back to the economics of the situation. I mean, yes, gold was $250 an ounce or $300 an ounce back in the day, but a liter of gasoline was 49 cents. So the economics, how did that change? I think that it would have if I would have known. It would have made, like I said, made me bolder in terms of going after projects. And that's where you actually look at today and you say, okay, where is the gold price going? I think it's going to go higher from where it is now, even 5,000. I think in the next 5-6 years, whatever you want to call on it, I think that you are going to be looking at maybe it's going to be 7,000, maybe it's going to be $8,000 gold, and I think that there's going to be a lot of demand. My thesis for probably the next decade is in my opinion, the last super cycle in commodities was the East building out. China and all those things. China modernized. So they brought electricity to China. All these things that happened, built cities, nuclear power plants, all these wonderful things over in Southeast Asia. And I think that what we're going to see in the next decade is a Western catch-up, and how that looks in terms of developing of commodities, modernization of infrastructure, everybody going to their own mineral independence. That's going to be what sort of drives this super cycle in the mining space. And I think that that's going to be somewhere between the next 3 and 10 years of the industry. That's going to be what is the news flow, in my opinion.
All right, I just want to look at this broader commodity complex one more time before I get to your company, Mike. This is the spot gold price over the last 3 months.
Yep.
Help us understand something. Why is it that a lot of the metals have been moving together? Silver and gold, we know that relationship, but take a look at copper. It's been moving up and down at exactly the same time as silver and gold. Now, I'm going to overlay this with platinum. Well, first palladium. And you can kind of see a similar story unfolding, especially in the last 2 weeks.
Mhm.
platinum as well. Now, I just is there okay, so that let me just fix that. Is there like a geological reason or explanation for this, or perhaps it's just institutional entities, right? Institutions buying and selling everything at the same time. And look, they're peaking at the same time, they're bottoming at the same time, they're moving in lockstep. And we
Yeah.
think about all these metals having different use cases. What is going on?
I mean, that is not a geological phenomenon. Nothing in
Okay.
geology happens in 2 weeks. Very, very
Right.
little. That is, in my opinion, that is market driven. And what drives the market in the last couple of weeks? Geopolitical,
Yeah.
what is happening down in the States, all sorts of wonderful
Sure.
things. I mean, there's protests in the streets about what is happening in the Middle East. All these things are coming together. But I also just think that to me, to a certain extent, looks like a bit of profit taking. People came in, on the 1st of January, got themselves an order of gold, silver, platinum, whatever. And in whatever it was, 26, 30 days, you're up 30%, 50%, 60%, whatever that number is, and get out. I mean, if it was any other stock, hit it, do it. There is rumors, Chinese selling all these things.
Hmm.
Obviously what was happening with the discussions about Greenland at the time, it's also putting things into focus. One of the things that I saw that was interesting, right when gold broke through $5,000 an ounce, mainstream media USA was talking about this. And it was the first time I was ever watching, mainstream CNN, ABC, and they're talking about gold. And that I think probably drove the immediate spike up to 5,500 when Ma and Pa are seeing on their news feed, hey, gold's through $5,000, it's up 20% or whatever it's up big and flying. And then I think that a lot of people piled in and drove it to $5,600 and then got out or got burnt. And I think that
Well,
that's, yeah.
tell us about the gold industry at large now versus the last cycle. So here I'm going to zoom out a bit now, Mike. So
Yeah.
here's the gold price zoomed out all the way to the beginning when it started free floating in 1971. But look at what happened in 2011. We don't have to go back all the way to 1976, 1979. Let's just look at the last bull cycle, Mike.
Yeah.
You were still working in the industry at the time. Why did gold fall from its peak around $1,900 down 40% to its trough around $1,000 and stay there for a couple of years? Let's talk about what happened that time, and then people want to know if we can draw parallels to today, basically if it's going to repeat this time.
I think that when I think back to those days, end of 2010, 2012. I mean, I think politically we were pretty stable at that point in time. I think that was the Obama era, if I remember correctly. It was an area of calm, and people could make more money in different places. This is when other industries started to really take off, and people would diversify. Now I think that the returns that you're seeing in precious metals, and actually even I would argue in some of the producers, would rival anything, and you're going to see a sector rotating. In terms of what I think is going to happen, there was an interesting article by Jeff Clark, published or gave a presentation at Veric, and he said, and his comment was, if this is the end of the bull run, this is the shortest one ever. And I don't think that it is, based on the thesis that I presented earlier. We're going to see a Western catch up. And so I think that, I go back to my thought is that we're going to crab sideways, for lack of a better term, somewhere around $5,000 for a few months, which is not a bad term or bad price. And then we're going to see a leg up. The other thing that's going to start to be interesting in the mining space or the gold space is you're going to see producers post quarters where they've had, for the sake of the argument, plus $4,000 gold. And you go back to the math of it all. If you're a 100,000 ounce a year producer and you put your economics out at at $1,000 less than spot, it's $100 million that's going on to your bottom line. If you're a big producer, Newmont, Barrick, whoever, you're going to have quarters that you're just going to absolutely destroy what the market expectation was. And I think you're going to see the gold stocks start to move and ultimately lead down into a buying frenzy in the smaller spaces.
Let's talk about money then. So if I were an investor and I don't know much about geology, which I don't, by the way, I would say to you, Mike, the price is skyrocketing. You're probably getting offers for financing left, right, and center. Can you just expedite drilling and exploration? Just make it faster right now, right? How would you answer that? Is that from a geologist perspective?
There's obviously there's rate limiting steps, and what you generally want or see is contractor availability. That becomes a rate limiting step, and then your permitting timelines. That's again why we work in Nevada. The contractors are there. They're generally busy, but they're good. And if you can stick your hand up early and say, we want a rig out there in the beginning of March, you can get a rig. Permitting, that again is a function of jurisdiction, and you can, as long as you manage your expectations in the market, you can do things quickly, but I don't think that you can't, it's not something particularly permitting that you can just throw money at.
Okay, so that leads me to the next section, which is talking about your projects in Nevada. Let's talk about the jurisdiction itself. You've worked all over North America. You spent time as a chief geologist in British Columbia. You spent time in Ontario. What makes Nevada unique from a geologist perspective?
Nevada is a special place from a geologist perspective. There's wonderful, neat, weird things that have happened to Nevada over the course of its history. You talk about, we can talk geology. The Walker Lane is the crumple zone where California docked into the States. That's kind of a weird thing on a global basis. It's a young belt of rocks, very similar to what is happening in the Archean stuff out in Ontario, but it's happening now. And so you get different things happening. Eastern part of the state where you get the big Carlin systems, they've been influenced by a hot spot going across the state. It's a combination of a lot of different geological factors, but imagine the burner of your stove sliding underneath something, and that heat creates mineralization. It creates uplifts, it creates fractures, and that creates mineralization. That's largely what drives the mineralization in the eastern part of the state and up into different states as you head out towards Yellowstone. It is a phenomenal, odd, weird, funny place, and that is actually what creates gold deposits. It's just having a lot of activity, a lot of heat, a lot of fluid going through that creates gold deposits, silver deposits, just about every type of deposit known to man. And that all happens multiple times in Nevada. It's just where it all comes together.
I would imagine, and please correct me if I'm wrong, but I would imagine that the contractors and the labor in Nevada, in a tier 1 jurisdiction in Nevada, which, by the way, the Fraser Institute has named the best mining jurisdiction in the world in past years. I would imagine in such a jurisdiction, the labor would be a little bit, the costs overall would be a bit higher. If someone were to ask you, Mike, you're going to start a company, a junior exploration company, and you could point anywhere in the world on the map and start a company, wouldn't you want to pick some place with a lower operating cost, someplace in, South America, for example, that also has good geology, but perhaps the cost of doing business are lower? How would you respond to that?
I would go back and say no. The reason why Nevada is the number 1 jurisdiction in the Fraser Institute rankings, it's top 3 year over year, is because it's a combination of the factors. It's got the great geology. It's got a good permitting jurisdiction or permitting environment. It's got the mining culture. And it's got the other thing that is quite interesting is it's got the accessibility. We spoke earlier, like I used to do work up in the high Arctic, and I remember sitting there, and this is in the year 2000, so 25 years ago, and I was there with my boss, and we're talking about a can of Coke. what does a can of Coke cost on this project? And this was Hope Bay up in the Arctic Ocean. We're looking at this can of Coke in the kitchen.
Let me guess. What year was this?
2000.
2000. Can of Coke. I'm gonna guess $5.
You're in the ballpark.
Okay.
We came up with $7.
Wow.
And that's to get a can of Coke to site. And you think about a liter of diesel fuel, a drill bit, steel, whatever it happens to be. It's incredibly expensive.
Sure.
But if you want to get a can of Coke in Nevada, I mean, you fly into Las Vegas, you get in a rental F-150, you hop over to Costco, and it's 23 cents in the cooler in the back of your truck, and away you go. Mining equipment, gear, people, fuel, it's all done with trucks. There's no helicopters, there's no float planes, there's no Hercules aircraft. It's just throw it in the back of your pickup truck and go. And if it needs to be a bigger truck, we'll get a bigger truck. And because there's another one there's a bigger truck just over there. There's all sorts of gear to get your stuff out. We're looking at a drill program where we're going to be mobilizing a drill rig here, and I believe the mob charge is going to be $12,000. If you wanted to get a drill rig into, for the sake of the argument, Hope Bay, you're probably looking at $100,000 worth of Hercules time just to get it there. So 100%, I would say that Nevada, if you understand what it is a great jurisdiction for a junior to be in. The argument against Nevada that you have to be aware of is, and this is U.S. mining, is the Canadian system allows for banking of exploration credits. So you can do a bit of work and hold a property for years. And in the States, as you could imagine, they're dollars driven. And so there's an annual claim fee that you have to hit every year. And it's not work, it's cash. And so that can be a bit of a dissuasion for a junior. But if you're well financed, manage yourself properly and execute, you can deal with it because it's predictable. September 1st, you better have that check in hand.
Okay, so tell us about your projects, StrikePoint Gold's projects. Give us just a sense of the scale, what you expect to find in the ground, and where you are right now in the process.
Yeah, in terms of the scale between the two projects that you've got up on the screen, the Hercules Gold project and Cooperite, we're actually the fourth largest landholder in the Walker Lane. It's Anglo Gold, Kinross. There's a lithium exploration company, then us. I believe those are the top four. Hercules Gold project is about 100 square kilometers. 1,300 claims, and the Cooperite Gold project is about 35 square kilometers. So it's a good part of the world to be in. And actually, on this map, you can see the expanded silicon. That's that new discovery. And so the Walker Lane that we were talking about earlier, the Walker Lane is a relatively underexplored part of Nevada. You can find outcropping mineralization sticking out of the ground in Nevada, in the Walker Lane, that you can start to drill off. I've done this before. On the map there's the Sterling asset. This was something that I was able to acquire, bought it for $10 million, sold it a few years later for $120 million. This is where I've been focused between Vegas and Reno. Where StrikePoint is right now, we're dominantly focused on the Hercules Gold project. That's the northern project that we've got here on the map. And what we're going to be doing there is we have an exploration target, 43-101 defined exploration target. It's a low level resource where no thought is given to economic extraction. It's just to think about the potential. And that's between 819,000 and 1.02 million ounces. So we asked the question, what would it take to drill this to get inferred? And we worked with the QP, and there was a cost benefit analysis done. And where everything sort of came together was about 3,000 meters of drilling, about a $1.5 million US program would get us about 1 million ounces in the ground if everything holds together and we're able to convert that exploration target into an inferred resource. There's a bit of a risk, but of course that's the nature of the business. So that will be what we're going to be focusing on. I think that it's an interesting opportunity for people because you think about the value that we're going to surface 1 million ounces of gold in the ground for $1.5 million US. Companies, I did a list the other day to show my board, and this was before gold moved up. Companies are generally in the Western US trade about $58 worth of market cap for every $50 US market cap for every dollar or for every ounce in the ground. So StrikePoint right now, we're at a $10 million US market cap for the sake of the argument. If we do that unearthing of value, we move up to a $58 US million market cap, $70 million Canadian. There's a real opportunity for shareholders to make a lot of money. That's a 7-10 bagger from where we are right now.
Yeah, you're at $12 million dollar market cap. Why do you think it's not fully reflecting the NAV of the inferred resources?
Because it's not inferred resources. It's an exploration target. And so that's what we need to do, is articulate what it is. So you're going to see the stock, and this is an opportunity for people, you're going to see the stock trade and grind its way up to that $58 an ounce in the ground over the next few months as we announce the drill program, start to put out results, and start to get a feel for this. And that should culminate sometime around Q3, Q4 of this year with a resource update. And then that'll be when we start to see the crystallization of all the effort.
Sure. So just on that note, give us a few catalysts or milestones that we should be watching out for this year.
Yeah, I mean, in terms of the milestones, we've spoken with the drill contractors. We're going to be launching the drill program here in the next couple of weeks. We're just trying to fine tune our schedule, and then after that, we're going to be. This is one of the other great things about Nevada and where we're located. Samples come off the hill. They're right into the prep lab in Reno. It's an hour away, and so we'll be getting pretty good news flow. I'm expecting it to be about 6 weeks from when we get the rig up the hill to start getting drill results out. You'll see those drill results spread out over the course of the late spring, early summer. There'll be a data compilation, and then we'll go into the resource estimate, and that should be out Q3 this year.
Well, just give us a sense of the history of your projects. Let's starting with Hercules, for example. It was acquired, I believe, in 2024. There was a previous operator, so it's not exactly greenfield. Was there drilling done before? Was there production on the site before? Tell us the history.
It's actually a really interesting history. I had it once before. So I bought it in a past life, did an option deal to acquire the project. And then we merged off with a producer. I think I bought it for the sake of the argument. It was a relatively modest sum. I think it was a few $1 million over several years, and we got it done. And then we merged off into a producer, and that producer ultimately stumbled. And then when they were going into CCAA, I was able to make an offer and get it back. And it's sort of, I talk about myself, and when people listen to me. I started my career as a geologist, and I used to look around for shiny things on the ground. Now I'm a CEO, and I look for opportunities. And so one of the things that happened when we were in that sale process, we had a new model that we tested for the Hercules mineralization, on which way the mineralization was dipping, what was controlling it. We drilled 19 holes, and then we had the offer to merge. And again, this goes into the history and being who you are. Do you gamble with your shareholders, or do you take the transaction? And we as a board had a discussion, and we did the transaction, and off we went into the merger. And then the drill results came in, and it's like, hold on a second, that model worked. And so, fast forward a few years, you see the producer stumble. And it's like, hold on a second, they've got a good asset in there. I did it, and we've now got a predictable model. So we were able to extract that out and for a very reasonable price. And then you turn around and you talk to the QP, and there's 300 drill holes into it that didn't make any sense until we said, try looking at it this way. And then the QP is like, okay, I get it. And that's where we got to the confidence of just a bit more drilling, tighten up the spacing, we'll be able to get to our inferred target or inferred resource.
If you didn't know about the project before, would you have looked for it?
I owned it once before. I owned it, for the sake of the argument, we'll call it 2019 to 2022, just right before and to the beginning of COVID, whenever that was.
All right. And finally, what's your end game for StrikePoint?
This is the great thing about being in Nevada is who's the logical acquirer? Who's the mine next door? Mm-hmm. And the answer is actually everybody.
That's right.
Because it's Nevada. And so I think about the company and say, okay, where are we going to go with this? It's most likely we define a million ounces. We do some metallurgical work, PEA, and people can see the pathway to production on it. Somebody's going to take us out. Who is that going to be? The nearest pure gold producer is Integra up at Florida Canyon. Coeur is in the area. I don't think Anglo Gold is interested. They're obviously heavily involved in the Walker Lane. Barrick and Newmont are walking around in Nevada. So there's a whole scheme of suitors that are available for the project right now.
Okay, excellent, Mike. Thank you very much for your time today. Tell us where we can keep up to date on your company's developments.
Yeah, it's StrikePointGold.com, and you can sign up for on there for the latest news releases.
Okay, we'll keep up to date there. So please follow StrikePoint Gold. Link down below. Thanks a lot, Mike. We'll see you again soon. Take care for now.
Take care.
Thank you for watching. Don't forget to like and subscribe, and follow StrikePoint. Link down below.